Hi there everyone, it's Siam from The Realistic Trader. Over the last couple of days we've seen some absolutely monumental moves in the currency markets with the Swiss franc unpegging from the euro. So I've had lots of questions and emails, so I thought I'd make a really simple video explaining currency devaluations and also currency wars. Currency wars is something which most people are unaware of, but it's going to be very prevalent over the next year or two. So to begin with, there's two types of inflation that we need to be aware of. So first of all, there's monetary inflation. So monetary inflation is when the governments or the banks basically turn on the printing press and they print currency. So that's monetary inflation. And then you have a thing called price inflation, which is normally the result of monetary inflation. So if all things being normal, you have prices which correspond to the amount of currency in supply. But if a government or bank starts printing lots and lots of currency, like QE for example, prices act like a sponge, and so prices grow in accordance with how much currency is out there. So for example, let's say an orange equaled £1, and the Bank of England set out a new QE program and over time doubled the currency supply, the pound sterling currency supply. Well, over time the price of that orange should, in theory, double. It should turn into 2. And as a result of our currency supply and exponential growth, most or pretty much every currency in the whole world has devalued at an alarming rate due to exponential currency growth. In fact, the pound has lost over 97% of its value over the last 100 years and 2/3 of that in the last 40 years. So this is something which will continue to happen. Now, moving more onto the currency wars. So an easy way to explain this is let's make a little example. So let's say we have 2 factories here, and they are chocolate making factories and they sell chocolate. Now let's say they're in 2 different countries which border each other. So for example, we could have the pound and over here we can have the euro. Excuse my handwriting. Now let's say a chocolate bar over here in Europe is $1 a chocolate bar, and also in the UK a chocolate bar is £1. Now we are assuming here that the pound and euro are the same, as in a 1-for-1 in terms of currency exchange. Now let's say there's a family over here, okay, and they love buying chocolate bars. So at the moment they're buying their chocolate bars from the UK at £1 a bar. Now let's say, for example, that all of a sudden, due to the ECB, the European Central Bank, printing lots of euros, this is going to devalue the euro. So let's say £1 sterling now equals €2. So what this means is that this family, this chocolate-loving family, instead of buying chocolate £1 per bar over here, they could actually go all the way over into Europe and buy 2 chocolate bars for the same £1. So what may happen is that lots of other families in the UK may start buying their chocolate over from Europe. So this factory over here in Europe is going to be very happy because he's going to be making lots and lots of sales, whereas this company over here, because they're losing out on business, they may end up having to close down unless the Bank of England over here starts printing more pounds, so that the pound starts devaluing, and so the exchange rate goes back to normal how it was. But can you now see that a chocolate bar is now £2 or €2? And if we go back to that previous slide over here, that shows us exactly what's happening. So don't forget, this happens all of the time throughout the world, and in fact we've been in a pretty ferocious currency war for the last 3 years, and it's only going to get worse. So what exactly happened with the Swiss franc then? Well, to understand this, you need to imagine that currencies are on a seesaw. So here we have the Swiss franc against the euro. Now, because Switzerland is always seen as a safe haven, there's been large money flows into Switzerland, and it's naturally a very strong currency, and so it naturally appreciates against other countries. What then happens is we have a very strong franc, and then we have a relatively weak euro. And because Switzerland is an exporting nation, this hurts Switzerland, because for a country to export things, it's best to have a cheaper currency. So in order to help its exports, what the Swiss National Bank did in 2011 was pegged the Swiss franc to the euro at 1.2. And the reason, and so the aim of that was to have a level playing field. So the European nation and the Swiss nation could import and export with relative ease. However, the Swiss franc naturally appreciates, and so in order to keep this peg at the 1.2 level, the Swiss National Bank had to print more currency and also buy more foreign currencies in order to devalue the Swiss franc, to the extent that by 2014, the Swiss National Bank had bought $480 billion worth of foreign currencies. That's 70% of Switzerland's GDP. This didn't go down too well with some critics, and so there are certain measures in place which means that only a certain amount of reserves could be used for foreign currencies, etc. And what actually happened was that there must have been the Swiss National Bank must have got wind that the ECB, the European Central Bank, were planning a round of quantitative easing. So if that were the case, the Swiss franc, the euro would have absolutely devalued even more so against the Swiss franc, which means that in order to maintain this peg, the SNB would have had to print lots and lots of Swiss francs. So this is something which couldn't have happened. So the Swiss franc, or the SNB, put the towel in, and they got rid of that peg, which meant that the Swiss franc rose 30% almost instantly against the euro, and the Swiss stock market dropped at least 10%. It was quite spectacular. In 10 years of trading, I've never seen a move like this happen within a day. So expect the Swiss franc to continue appreciating against the euro, especially if the ECB launches a round of QE. So if the ECB does launch a round of QE, for my traders out there, here's what to expect. Short the euro dollar and short euro Swissy, because at the moment the dollar is relatively strong. It's having a bit of a rally, and also the Swiss franc is also rather strong. So expect euro dollar to fall and also euro Swissy to fall. Also, there are also signs that Denmark are experiencing an almost identical situation to what happened with Switzerland. So if that happens, expect that the Danish kroner to rise in value against the euro. So I hope that helps. Sorry it wasn't the most slick of videos, but hopefully that should explain things. I'll speak to you soon. Cheers. Bye bye.